Hello, my name is Corey. I'm a TA here in the accounting lab, and I have been asked to create this video to explain to you the principles of allowance for bad debt and bad debt expense. Um, you may already know that Professor Larson has also created a video, and also another TA named Mikkel, and we're creating these videos because this is a topic that a lot of students often struggle with. And so we're trying to give you different resources because we all explain this a little bit differently, and it may click with you the way I explain it as compared to the way that Professor Larson has explained it, or Mikkel, or even your teacher in class. And so feel free to watch all of these videos. It's going to be fairly similar, but we all explain it a little bit differently, and one way may click better with you. The way I'm going to start explaining it is just through helping you understand the relationship between journal entries and T accounts, because using the T accounts for accounts receivable and allowance for bad debt will be key for answering the questions that you will be asked on the exam, and also just for understanding the principles of bad debt expense and allowance for doubtful accounts. So first, I've drawn some journal entries up here on the board. This journal entry here, debit accounts receivable, credit sales revenue, is a journal entry that should be familiar to you. It's the journal entry that we make whenever we make a credit sale. Next, I have the journal entry that's debit to cash, credit to sales revenue. Again, this is a sale, but it's just a cash sale, not a credit sale. Third, we have a debit to cash and a credit to accounts receivable. And this is the journal entry when we collect cash from the customers that we previously sold to on account. And so that's our cash collections from our credit customers. And the way that these journal entries relate to the T accounts is accounts receivable and cash are both real accounts. So they are going to have beginning balances on their debit side because they're assets, they're natural debits. But sales revenue is a nominal account, so we close it every year, so it's not going to have a beginning balance. It's always going to start at zero. And then at the end of the year, the company is going to take these journal entries and they're going to post them to the T accounts. So here in a credit sales journal entry, we debited accounts receivable. So we're going to debit accounts receivable in the T account for credit sales. This same number would also go on the credit side of our sales revenue T account. Credit sales are going to increase sales revenue. Then we get to this journal entry. We're going to debit our cash T account for cash sales. And again, we're going to credit our sales revenue for cash sales. Next, we're going to debit cash for cash collections, abbreviate that. And lastly, we credit accounts receivable for the cash that we collect from these customers, because when they pay me, that accounts receivable goes down. So I want you to try to understand this relationship. The journal entries just get put into their respective T accounts. So if we did not have the journal entries, but you had the T accounts, you could figure out what the journal entry was. For a credit sale, the journal entry is a debit to accounts receivable and a credit to sales revenue. For a cash sale, the journal entry is a debit to cash and a credit to sales revenue. Next, for cash collections, we have a debit to cash and a credit to accounts receivable. So the journal entries and the T accounts work together. So that's why for these bad debt expense problems, we always start off by just drawing two T accounts, an accounts receivable T account and allowance for bad debt T account, because it already has all the information you need to answer the questions. It tells you what the journal entries are, it tells you where the numbers come from. So I'm going to go ahead and I'm going to pause the video. I'm going to erase this. Feel free to write this down if you need to, or to stop, and if you're in the accounting lab, ask a TA for any questions, because this will be critical to understanding how to do these problems. And then I'm going to start the video again. I'm going to have some things drawn on the board, and we're going to talk about accounts receivable and allowance for bad debt. All right, hopefully that was helpful to you. We now have here an accounts receivable T account and an allowance for bad debt T account. So we're actually going to talk about allowance for bad debt and bad debt expense now, try to help you understand what's going on, and make sure you know what you need to know to do well on any of the problems that your professor may throw at you. So as a quick little review from what we did before, we have 2 of the 3 journal entries that we wrote previously. We have the credit sale journal entry and the cash collections from credit customers journal entry. We took out the cash sales journal entry. Why? Because that journal entry does not affect accounts receivable or allowance for doubtful accounts. When I make a cash sale, I debit cash, I get cash, and I credit sales revenue. Neither of those 2 accounts are accounts receivable or allowance for doubtful accounts. So all we're worried about here is our credit sales and the cash that we collect from those credit customers. Okay, so I'm going to go ahead and erase this. Actually, and I want you to remember that these journal entries just go right into the T account. When I make a credit sale, I'm debiting accounts receivable, so we put that here on the debit side of our accounts receivable T account. When I collect the cash, I credit accounts receivable, so I'm putting that on the credit side of my accounts receivable T account. Okay, so I'm going to go ahead and erase these journal entries, and now we're going to talk about some items that are a little newer for you and help you to understand the journal entries. So there's one more item that affects accounts receivable, and that is a write-off. And a write-off also affects the allowance for doubtful accounts. And one other item here, we have bad debt expense. I'm going to explain these in a second, but just a couple things I want to point out. Remember that accounts receivable is an asset, so its beginning and ending balance is on the debit side. It's a natural debit. The allowance for bad debt is a contra asset. This means it goes under the asset section on the balance sheet, but it acts as a negative asset. It decreases our accounts receivable. And so its natural balance is a credit, opposite of an asset. So its beginning and ending balance is going to be on the credit side. Also, what I want to point out is if we remember the relationship between T accounts and journal entries, then we know right now what the journal entry for a write-off is. It's a debit to the allowance account and a credit to accounts receivable. So I'm just going to write that for you here. Debit your allowance account, allowance for bad debt or allowance for doubtful accounts. That's going to be your debit. Accounts receivable, credit. It's right here in the T account. One more time. Debit, allowance, credit, accounts receivable. That's your journal entry for a write-off. I'm going to hit that a lot because it really is critical to understanding how to do these problems. T accounts will help you in so many ways, not just with allowance for bad debt, but when you're doing depreciation expense, when you're just trying to figure out adjusting journal entries and what they need to be at the end of the year. Understanding how T accounts work is crucial, so I'm going to hit that a lot. Next, we have bad debt expense here. I'm just showing you the journal entries. I'm going to explain the concepts in a second. Bad debt expense, this is one that trips people up. They think bad debt expense is an expense, so it should be a debit, but why are we putting it on the credit side? Well, you have to remember how the T accounts work. We're labeling this number bad debt expense, just like we labeled this number cash collections, or just like how we labeled this number credit sales. But what are we really doing? We're crediting the allowance. The debit is to bad debt expense. So your journal entry, its adjusting entry at the end of the year, is to debit bad debt expense and to credit your allowance for doubtful accounts. So I'm going to explain that one more time. This is your adjusting entry. To record bad debt expense. Okay, so one more time. When we record bad debt expense, we are not crediting bad debt expense. Bad debt expense is just the title we're giving this number. We are crediting the allowance and debiting bad debt expense. So remember, expenses are naturally debits. We're going to record them with a debit. That's your journal entry. Okay, so now I'm going to try to explain a little bit of what's actually going on. So in a very simplified example, if I have a balance sheet that shows accounts receivable for 100, and I have an income statement that shows sales for 100, at the end of the year, I need to ask myself, is it accurate for me to say that I'm going to collect $100? Because in my experience, generally, I don't collect everything that I sell. There are some customers that are bad, that just don't ever pay. So what I want to try to do is I want to update my financial statements to reflect that even though I've made $100 of sales on account, some of those customers aren't going to pay me. So I make one journal entry to fix both my accounts receivable on the balance sheet and to take a hit or record an expense on my income statement. So I do that by recording an allowance and by showing bad debt expense. And I can do that in one journal entry right here. I make an adjusting entry at the end of the year to show an expense, bad debt expense, to fix my income statement, and to record the contra asset, the allowance, that's going to reduce accounts receivable and correct my balance sheet. So let's just make up a number and say I do that for $10. So what I'm saying in this simplified example is, even though I've made $100 of sales, and I have $100 on accounts receivable, I really only think I'm going to collect 90. So I reflect that here. And I did that by just making one adjusting journal entry. But we have to remember that this number is a guess. We don't know for sure who's not going to pay. If we did know who wasn't going to pay us, we would have never made the sale in the first place. So we are just making our best estimate to try to be as accurate as we can and provide useful information to the users of the financial statements. So what we have to do is we have to have a way of making those estimates, and there's two main ways to do that. The first way is we use something called the percentage of credit sales method. What we're doing here is, your problems will say something along the lines of, management uses the percentage of credit sales method to estimate their uncollectible accounts for the year. And they have determined that 3% of credit sales are going to be uncollectible. So in that case, what we're doing is we're taking a percentage of our credit sales. This is method 1. So I'm going to take 3% of this number here. And whatever I get when I do that is going to give me my estimate bad debt expense. So when I take 3% of credit sales, let's just say I get 100, I'm going to take that 100 and put it here in the T account for bad debt expense. The reason this works is because we're taking more of an income statement approach, meaning management's looking at their income statement and we have our sales number. And they say, well, how much of those sales aren't going to be collected? That's the hit that we have to take on the income statement, which is bad debt expense. Expenses go on the income statement. So this method is going to give you your estimate for bad debt expense, and then we're going to have the beginning balance, the write-offs, and bad debt expense, and we can solve for our ending balance. So we're going to solve for allowance. That's more of the income statement approach. I'm going to write income statement right there. Okay, method number 2. Instead of taking an income statement approach, we can take a balance sheet approach, which would be a percentage of our accounts receivable, or sometimes the method will be called aging of accounts receivable. But in either case, the focus of this method is on our accounts receivable, which our ending balance in the accounts receivable T account, that's the number that we're going to show on our balance sheet. So this is method 2. We're focusing on the accounts receivable, and whenever we do this method, the result of it is going to give us the ending balance for our allowance, meaning the problem states something along the lines of management uses an aging method of accounts receivable, and upon performing that analysis, they determine that $50,000 are going to be uncollectible. Well, that $50,000 is a result of taking a percentage of our accounts receivable and is going to give us the ending balance in the allowance account. So after we do that, we'll have the ending balance in the allowance, we'll have our write-offs, and we'll have the beginning balance. So the only number that's missing would be bad debt expense in that case. So this method gives you the allowance, and you have to solve for bad debt expense. So those are the 2 ways that we're going to make our estimates of bad debt expense and the amount of allowance that we need so that we can make a proper adjusting entry at the end of the year to fix our balance sheet and our income statement. This journal entry is always going to be based off of your bad debt expense number, that number right there. So you're going to debit bad debt expense, credit allowance for whatever number's here, and that number will change depending on which of the 2 methods you decide to use. Okay, so I'm going to erase this. If you don't have it down, go ahead and pause the video and write it down, take any notes you need to. I'm going to erase this really quick. The last thing I'm going to explain here is write-offs. So if we go back to our example of the balance sheet, we have accounts receivable, we have allowance, and when we subtract that, we get net accounts receivable. So my question for you is, when I set up the allowance here through this adjusting entry to fix the balance sheet, why didn't I just credit accounts receivable? Why didn't I just get rid of the accounts receivable? Why do I have to use this reserve or this allowance account? And the answer to that is because we are just making an estimate. We don't know which customer it is that's not going to pay. So I can't write off the account because I don't know which customer's account to write off. So I have to use this generic account, this reserve, until I know who it is that's not going to pay. So at the end of the year, the company says, you know what, I don't know who's not going to pay, but I know somebody isn't, so let me set up this reserve. Then I go into next year, and some of my customers start to pay me, some aren't. But as time goes on, 3 months, 6 months, 9 months, I start to realize, it's been a long time since I made that sale, and that customer still hasn't paid me. So more than likely, they're probably never going to pay me. And so at this point, it's not worth keeping track of anymore. I'm just going to go ahead and write that customer off. So the way I do that is I say, I now know who it is that's not going to pay. So I don't need as much of a reserve, so I'm going to take from the reserve and I'm going to write off that customer's account. So that's what this journal entry is doing right here, the write-off. I'm decreasing the allowance. Remember, the allowance is a natural credit, which means it decreases with a debit. So I'm decreasing the reserve account. I'm making it smaller. I'm drawing from the reserve. And I'm decreasing accounts receivable. I'm writing off that customer's account. So that's kind of the idea behind what's going on. But just a couple things to remember. The T accounts, they tell you everything you need to know. Remember, you have an income statement approach and a balance sheet approach to estimating bad debt expense in your allowance, and all the journal entries are reflected right here in the T account. The journal entry for a write-off, debit to allowance, credit to accounts receivable. The journal entry for bad debt expense, expenses are naturally debits, so we're going to debit bad debt expense, and we're crediting allowance. And if you understand these T accounts, you understand the different components of the T accounts and where they come from, you're going to do great on these problems. And if you still have questions, remember there are a couple of other videos that you can go and watch. And also the Accounting Lab is a great resource. All the TAs are great and would love to help you understand it more. So thanks for watching, and hopefully you can do well on these problems.